Welcome friends, welcome to freetaxedu.com. Today we will start with the income tax session, income from capital gain part 2. If you remember, in part 1 we learn about what is capital gain, capital asset, type of assets, type of capital gain, how we can calculate the capital gain, and some important definitions or important terms uh, in the capital gain, calculation of capital gain. So in this session we are going to learn about indexation, as we promised earlier in the previous session. So what is indexation and how we can calculate by using the indexation, how we can calculate the value of capital asset using indexation. So first is, what is indexation? Indexation of a cost can be defined as increase of value of asset considering if the capital asset is purchased by assessee in the year of sale. That means by doing the indexation we increase the value of asset considering that the capital asset is purchased by assessee in the year of sale. That means if what if the assessee purchased this asset and this asset in this year. So we try to match the value of that asset with the consideration. These index numbers are scientifically calculated and provided by the income tax department. So for calculation or doing the indexation of cost, there are some index numbers provided by the income tax department, and these are scientifically calculated. This is already provided. We just take it from the table provided by income tax department. Indexation is done only on long-term assets and not on short-term assets. You have to remember this thing, that indexation is done only on long-term assets. Index numbers are available up to, that is 1st April 1981, with the base index 100. That means if you have purchased, or if you have ancestor property which is purchased before 1/4/1981, then you have to take base year as a 1/4/1981, that is 1981-82, using this base index number 100, because income tax department provide us index numbers from 1st April 1981 to till date, and they have not provided any index numbers before for the years which are before the 1981. These index numbers are indicated financial years in which capital asset purchased or sold. So we need to use this. How we can use it? We can I will show you the examples in the upcoming slides. If assessee owns a capital asset before 1/4/1981, then assessee should take 1981 as a base year and value of capital asset in 1981-82. Suppose somebody purchased a home in 1950 or 1960 having a value of rupees 5,000 and sold it in 2014. So we have an index number for 2014, but we don't have an index number for 1960. So what he should do, he should take the base year as a 1981 and assume, or need some scientific calculation, that what if that asset is purchased in 1981 and 82. If he purchased for 5,000 in 1960 and in the value of that asset in 1981-82 is 20,000 rupees, then we need to take 20,000 as a base value or cost of acquisition for that asset. So this is the cost inflation index as notified by central government, is as under. If you see, financial years, and cost inflation index. It starts from 1981-82, and the base year, for that base year, the cost inflation index is 100. 1982-83 109, in 1991-92 it is 199. You can download this chart from the website. It's freetaxedu.com. You can, that is available on the website. You can see that. So up to 1415, that index is 1024. So how we use this indexation process? So this is first indexed cost of acquisition, that is ICA. So cost of asset into index in the sale year and divided by index in purchase year. So index cost of acquisition, ICA means index cost of acquisition. For example, Mr. X, name is not written here, Mr. X purchased a house in 1st April 1991, where the cost index is, you can check out, in 1991 it is 199 for rupees 60,000, and sold that house on 1st January 2015, where the cost inflation index is 1024 for rupees 7 lakhs. Calculate the capital gain on the sale of that land. So we use this above formula for calculation of capital gain. So ICA is a indexed cost of acquisition is equal to cost of asset into index in the sale year and index in the purchase year. So cost of asset is rupees 60,000, index in the sale year is 1024, and index in the purchase year is 199. So index cost of acquisition is 60,000 into 5.1457, and the value is 3,08,742. So this is the indexed cost of acquisition. Even though the person or assessee has purchased this for 60,000, but still if he want to sell this property in 2015, by doing the indexation, the value of asset is increased by margin, and the value is now 3,08,742 rupees. So indexed cost of improvement, ICI. The indexed cost of improvement is equal to cost of improvement into index of sale year and divided by index in improvement year. For example, say Mr. X did some improvement in the house 1st April 2002 worth rupees 50,000. Calculate the cost of improvement for the house. You can see the formula: cost of improvement into index sale year and index in purchase year. The cost of improvement is rupees, say, 60,000 into 1024 divided by, which is the index in sales year, and 447, which is index in purchase year. So the value, after doing the calculation, the value is 1,14,540 rupees, which is cost of improvement. So I hope you come to know the indexation process and how the cost of acquisition and cost of improvement is calculated by using these simple formulas and the index numbers. Remember, this is the basic information. Once again, this is not a full-fledged information about the capital gain, because capital gain is a big chapter. So we are providing only the basic and important thing, how to calculate this capital gain easily. So if you want to learn this in depth, you can log into freetaxedu.com pro version, which is a paid version. You will get the complete description or complete detailed information regarding the cost capital gain and these calculations. So that's it. Thanks for visiting freetaxedu.com.